How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about managing bank liquidity. There have obviously been tremendous changes in the market. We're going to go through all of that in just a second, but I found a great article in Bank Director that really gave some great key points here on how banks can better manage their liquidity, the current liquidity situation. So let's jump in and take a look at that here. So this is called Navigating the New Liquidity Landscape. So as banks face an ongoing shift in funding, data is crucial for liquidity management. Now, in the aftermath of the pandemic, the financial disruptions that followed, the U.S. banks are grappling with new challenges and managing liquidity, adding deposits, funding mixes, and regulatory requirements that are shifting in unprecedented ways. Recent economic changes have impacted and reshaped how banks approach balance sheets, particularly when it comes to their liabilities. A surge in government stimulus, coupled with the collapse of prominent banks like Silicon Valley Bank and Signature Bank, contributed to a sudden shift in the liquidity environment that financial institutions must now navigate. So what were some of the key things that happened here? So as you can see here, the first kind of thing that happened to change the environment was the pandemic-related deposit surge. So before the pandemic, U.S. banks deposits grew at a steady 7% annual rate, but government stimulus measures and reduced consumer spending during the pandemic led to a spike in deposits. Bank deposits grew by 22.2% in 2020 and by 10% the following year. So by the end of 2023, balances had fallen by about 4.6% from the peak in early 2022. Since mid-2023, deposit growth has resumed, but at a slower pace with a 1.7% annual growth rate, raising questions about whether this is a temporary anomaly or a new long-term trend. So this is a great chart here showing total deposits of U.S. commercial banks, and you can begin to see how, banks from 2000 to 2019, they had an annual growth rate of about 6.9%, not too shabby. But you could see here, starting in 2020 with the pandemic, those numbers just got shot up. So basically, by the end of 2020, 21, 22, banks were really, really flush with deposits. But then, as the economy started to open back up, people got back to work, people started spending those funds, companies started spending those funds. Again, hopefully they use those funds as intended to keep employees on the payroll and, so on and so forth. But the reality was those deposit balances began to drop back down, and banks are left with now a much slower growth rate of only 1.7%. Then we got hit with basically bank failures and regulatory responses. So the financial landscape is riddled with warning signs that point toward potential liquidity issues for banks. An inverted yield curve from July of 2022 to September of 2024, historically a precursor to economic downturn, suggests that short-term funding costs could remain elevated despite recent rate cuts, squeezing profit margins. Compounded by a shrinking M2 money supply and investment portfolios with unrealized losses, banks face challenges in lending and maintaining liquidity. Now, let me take a time out for a second. There's a key thing that they're missing here. What happened starting in 2022? The Federal Reserve went on the largest and most aggressive interest rate hike, tightening environment, if you will, that they have ever done. They had 11 interest rate hikes between 2022 and 2023. Now, those interest rate hikes caused the unrealized losses in the bank bond portfolios because, banks didn't think the Fed was going to increase rates as much as they did. They went long in their bond portfolios, and voila, you now have this major situation with banks and unrealized losses. Now, I've reported on that in many episodes that I've done this year. So it's been a big thing in the industry for a little while now. So you had the surge in deposits, then you had the increase in interest rates, which led to the unrealized losses. And then you had the banking crisis of early 2023, where you had Silicon Valley Bank fail, Signature Bank fail, First Republic Bank fail. And then that obviously led to a big regulatory reaction from the regulators and basically looking at liquidity, because liquidity played a big role in those bank failures. So now we come upon this, what they call this shift in the deposit mix. So the mix of deposit types has also undergone significant change. So non-interest bearing deposits surged during the pandemic as customers sought liquidity. According to data from the FDIC, these deposits, which represented 30% of domestic deposits in mid-2022, have since fallen to 22% as depositors pursue interest-bearing accounts. Now, I will point out that from 08 to 2022, during that period when the Federal Reserve basically kept interest rates artificially reduced at basically 0%, banks were able to get a lot of non-interest bearing deposits. Basically, banks were able to shift their deposit mix to non-interest bearing accounts because the interest rates were next to nothing. The savings accounts, the money market accounts, the different interest-bearing CD accounts, the different interest-bearing accounts that banks provided basically paid little to no interest. So, people didn't really necessarily care because if you move from an interest-bearing checking account to a non-interest-bearing account, you weren't really getting much interest, so it really didn't make that much of a difference. So banks were able to sell and persuade customers to put their money into non-interest-bearing accounts. Well, all of a sudden now you have interest back in the market again. People for the last few years have been able to get a 5% CD. That's changed customers' perceptions. Now all of a sudden they're not as willing to accept a non-interest bearing account. And now all of a sudden the customer's coming in asking the bank saying, "Hey, is there someplace else, another account that I could park my money and actually earn some interest on it?" So, and then you can see here from this chart, interest bearing versus non-interest bearing deposits. And you can see here, basically, the S&B, the signature bank failures right here, 70%, 78% here. So this is interest bearing deposits domestic. And then the orange at the bottom here is non-interest bearing deposits domestic. And you can see here that basically that has dropped down from 30% to 22%. Just like I said, customers want interest bearing deposits now. Interest-bearing deposits account for 78% of all U.S. deposits, up from 70% in 2022. A shift from non-interest-bearing checking accounts to higher-yielding options has particularly pronounced after SVB's collapse. Banks are also seeing a resurgence in retail time deposits, such as certificates of deposit. While CDs represent just 2% of deposits in early 2021, by mid-2024, that figure had risen to 10%, indicating a renewed appetite for fixed-term investments in the current rate environment. Again, now accounts or demand accounts and MMA versus time deposits. So you can see here, basically the estimated now and MMA deposit accounts right here, up here at 63%. Retail CD domestic dropping down, but back up, but popping back up to 10% here. And then brokered CDs, domestic deposits, running about what is that? Around probably about 6%, 6 to 7%. So then it basically gets into, okay, so what are banks going to do about this? Well, you have a lot of data-driven liquidity management becomes essential. So banks are increasingly turning to data-driven strategies to manage liquidity. Regulators require financial institutions to maintain cash reserves of 10 to 15%. But meeting these requirements while optimizing balance sheets requires careful analysis and forecasting. Banks can use real-time data and predictive analytics to better forecast shifts in deposit flows, loan demand, and funding costs. This allows them to make more informed decisions about their liquidity strategies, ensuring they have enough cash on hand to meet withdrawals without holding excessive reserves that could otherwise be used for more profitable investments. Data is critical for managing the sources and uses of cash across a bank's operations. Banks can analyze trends in consumer behavior and market conditions to optimize their liquidity positions, reducing the risk of a liquidity crunch while maintaining competitive lending practices. Net interest margin is still key for profitability, absolutely. And then it just finishes up by saying, looking ahead. As banks adapt to a post-pandemic world, the key to success lies in balancing liquidity, profitability, and compliance. How well banks manage liquidity could determine their ability to remain competitive and whether any future financial storm and weather future financial storms. As the economy evolves, one thing is clear. In the new liquidity landscape, data isn't just important, it's essential. And I would further that estimate by basically saying, you have a lot of issues right now with the broker deposits, banking as a service. This has added new wrinkles to, what could potentially make liquidity management even more challenging. Potential changes to the Federal Home Loan Bank could make things more challenging. The Fed wanting to push more banks to basically utilize the reserve window. Again, these are all what seem like small changes, but add up to very big changes over time. So again, I thought this was a really good article because it kind of summed up very nicely all of the challenges over the last couple of years, which have just led us to this current environment where we're at, and basically the challenges that banks now have in kind of managing their liquidity mix to make sure that they're still maintaining healthy reserves and healthy profitability, basically continuing to run a good business, as it were. So again, something we'll have to keep an eye on, and I'm sure I will have more information in this arena as we move forward into 2025. Bank liquidity management, bank balance sheet management are always hot topics and always things that are being discussed based on the different things that are going on in the market environment at the particular moment. So I will wrap up by basically saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel. And do not forget that every Saturday night, I do the BND live stream, which is called Strategy Room, and that is on YouTube at 8 o'clock every Saturday night for the most part. But please check that out if you get a chance. That will be coming up tomorrow night at 8 o'clock, and I hope to see everybody there. But until then, have a wonderful weekend, and I will see everybody again next week. Thanks a lot.